studying Chapter 14. Chapter 14 is the first of four chapters that look at control systems. So, controlling is our set of procedures, tools, and systems that we use to monitor activities and look at the performance goals of the organization. So, what is our core performance measurement system, and are we meeting those goals? So, we have the different management duties. So we have planning. We looked at planning, that's part of budgeting and strategic analysis. Then control is what we're looking at now. Control is when we look at performance analysis and say, how well did we do? How was our planning activities to our actual activities? So when we're looking at control, we're looking at short-term operational performance. So what was our comparison between our actual and budgeted financial results? We're going to look at different variances between our budgeted amounts and our actual results. So we're going to use this theoretical company in the next few chapters, the Schmidt Machinery Company. We use the 5 steps in a decision-making analysis that we've been talking about in every chapter since chapter 1. And we're going to look at the short-term financial control or variance analysis for our fictional organization. So we have our static budget to our actual operating budget. So a comparison of our actual and budgeted operating income. We see that we have an overall unfavorable operating income effect. So, and we have various unfavorable variances. The only favorable variance we have is our total variable costs. So when we're looking at, we want to know what these different variances are telling us and what they're looking at. So the first variance we're looking at is just the difference in actual to our static budget or our master budget, called the static budget variance. That is that $72,000 unfavorable operating income variance. We're going to break that variance down into other variances. We would want to create a flexible budget to compare our master static budget to, and also look at our actual numbers. So our master static budget was for 1,000 units, but we can see here that our actual operating income is based on 780 units. So we would design a flexible budget at our actual amounts to determine what our master budget would have been if we had created our master budget for 780 units. So here we have a 780 unit flexible budget that is based on our master budget rate. So our sales of $800 per unit and our variable costs of $45 or $450 per unit. When we're looking at the total operating income variance, that is a variety of factors. One, our actual sales volume was different than planned. So our budgeted sales volume was 1,000 units and our actual sales volume was 780 units. Our actual variable cost per unit was different than planned. Actual total fixed costs are different than planned, and our actual selling price per unit was different than planned. It could be one or more of these factors. So if we look at this flexible budget, this allows us to look at the components related to each of the above 4 factors. So if we go back to our original static budget, we can see that the total percentage or contribution margin between the actual and the master is different. Our fixed costs, we paid more than we budgeted. So we're going to look at what would a flexible budget have looked at for us. So at 780 unit level, we have operating income of $123,000. We have a variable cost per unit of $450. So now we can look at our total variance. So we break our total operating income variance, which is also called our static budget variance, into our flexible budget variance and our sales volume variance. That total unfavorable variance is caused by the different volumes between our static budget and our actual budget. Our flexible budget variance is actually a favorable variance. So when we compare 780 units of actual results to what 780 units would have looked at in flexible results, we can see that we actually had favorable results, with the exception of our fixed costs. We can then break these variances down further into different components of our production schedule. So I already talked about this breakdown of our total flexible budget variance. This is the difference between our flexible budget and our actual budget. Then we had the difference between the static budget and the flexible budget. That's called the sales volume variance. Almost everything in this variance is caused only because of the difference in the sales volume. We can break down that total flexible budget variance even further. So we can look at our selling price variance. So what were our actual sales compared to our flexible budget sales? Or our actual quantity of units times the actual price minus our standard or budgeted price. Our total fixed cost variance is the actual fixed cost minus the flexible budget fixed cost. This was a spending variance on fixed costs. This can be broken down even further between what part of those fixed costs were individual costs within categories and which were functional costs. So here we have total variable cost variance, or actual variable cost minus the flexible budget variable cost, or actual quantity, 780 units, times what was our actual variable price minus our standard variable price per unit. The total variance can be broken further down into what was our direct materials cost, what was our direct labor variance. So when we're looking at these total variances, we can look at variances in our direct materials costs, variances in direct labor, variances in our overhead and selling and administrative expenses. So we have our actual results compared to our flexible budget results. Our flexible budget variance gets broken down into a price rate variance and a quantity or efficiency variance. So this calculation schedule is the same both for direct materials and direct labor. So we have the difference between actual input, our actual results, our flexible budget, which is part 2 in the middle, which is our actual units times our budgeted rate, and then our flexible budget amount, which was the standard quantity times the standard rate. So we would have a direct material price variance and then a direct material quantity variance, or a direct labor rate variance and a direct labor efficiency variance. We're going to look at each one of those variances broken down even further. So those formulas between our different costs are just shown differently here. So the price rate variance is actual quantity times actual price minus standard price, and our quantity or efficiency variance is standard price times actual quantity minus standard quantity. So when we look at our direct materials variance, as I said earlier, we have first our materials purchase price variance, and then second, the materials quantity variance or usage variance. So when we look at this example, we have a direct material. We have a standard of using 1.5 pounds per unit at $4 per pound. Last month, we used 1,700 pounds material to make 1,000 jerks. The material cost a total of $6,630. So if we take our cost divided by the pounds of usage, we get an actual price of $3.90 per pound. We take our actual quantity of 1,700 pounds times the $3.90 per pound we actually paid minus our $4 standard price and end up with a $170 favorable direct materials cost variance. For our quantity variance, we should have used 1,500 pounds. We have a standard of 1.5 pounds per unit, and we made 1,000 units. We actually used 1,700 pounds. So we used more than 200 pounds allowed for standard production, which gives us an $800 unfavorable quantity or usage variance for direct materials. So when we break that down, we have our actual quantity and actual price of materials used, our actual quantity and our standard price of materials used, and the standard that was allowed for that level of production. Therefore, we have a positive price variance and a negative usage variance. So common causes of these variances, one, a price variance could be we just got a discount. It also could be that we bought lower quality products. We also might have had extra costs related to freight or delivery. Usage variances can be caused by one, if we are using less quality materials, we might have more scrap or rework. If our staff isn't properly trained or our direct labor they could ruin materials while they're still learning in the production process. We also could have poorly maintained machinery that could be ripping a direct material or destroying direct material as it's being used. Next, we're going to look at labor variances. So common causes of direct labor variances can be labor substitution, out-of-date standards. We could have new employees on. So if we saved money versus our standard cost of labor, it could be because we have a lot of new people on. Our efficiency variances can be trained, one, because new people or the people we have are poorly trained. We could have poor quality materials that are causing a lot of scrap and rework. We could have equipment breakdowns that's giving us slack time. We might not be supervising our workers well and they're just hanging out and they're not working as hard as they could be. Or we might have out of date standard costs or standard rates. So how do we develop those standards? So the standards that we develop are what our costs would be under efficient and normal operating standards. So we develop a standard cost system. The standard costs, not the actual costs, are what flow through our formal accounting records. Our standard costs are useful for conducting variance analysis for financial control purposes. So if we use a standard costing system, we use variance analysis in our accounting records. This includes the recording of our inventory costs, our direct materials usage, our direct labor costs, and our overhead costs. We have multiple different kinds of standard costs. So we have ideal or perfection standards. So these standards, the ideal or perfection standards are the standards that would exist if we had perfectly running operations. So if we were at our maximum efficiency, it's very difficult to hit these standards, but not impossible. Continuous improvement standards, these look at Kaizen standards. So we tighten up our standards and they get progressively different over time. So this goes back to like our learning curve, where we say that we're going to get more and more efficient at that production process. So if we say it takes an hour the first time, then we're going to start reducing time every time throughout the months of our standards. And then currently attainable standards. So what are our current normal operations? What are the standards of those? So what under normal efficiency and normal production, what are our costs of direct materials, labor, and overhead? We can have two different kinds of standard setting procedures. One is authoritative or top down, and the other is participative or bottom up. So participative usually gives us better standards because we are getting active participation from the employees who are affected by those standards. We would develop a standard cost sheet. The standard cost sheet gives us the expected price and quantity component of each cost. On the next slide, we'll see an example of a standard cost sheet. So this is an example of our standard cost sheet for our machinery company that we're going to be following through this chapter and the next couple of chapters. So we have our expected quantity of direct materials and their cost for production, our expected quantity of direct labor, variable overhead, fixed overhead, and this gives us our standard manufacturing cost per unit. We also have standard variable selling and administrative costs per unit. And we would use these standards when creating our budgets and our flexible budgets. And we would use these standard rates to compare against our actual results. When we're using a standard costing system, as I said earlier, we are going to record those standards in our journals. This is an example of how we would record any variance for direct materials and usage. So we have our materials inventory and our accounts payable. So our accounts payable is the actual quantity at the actual price. But what is recorded in our materials inventory and our work in process inventory and all of our inventory throughout is just the standard price. Then we would record variances in separate variance accounts. Those variances should, if we have good standards established for our costs and our records, those variances should net themselves out throughout the year. We should get final variance amounts in those accounts. Those accounts then are written off at the end of the year to cost of goods sold. If there are significant large material numbers in those accounts, we need to rethink setting our standard costs. Our standard costs are obviously off at that point, and we need to rethink what our standard costs are being used. We also need to think about non-financial measurements. So one of the limitations of looking at financial and operations controls such as variance analysis is sometimes it tends us to focus on short-term financial situations. And if we just work at fixing short-term problems, we can actually make long-term things worse, or we might not be looking at the long-term things that need to be fixed. So we need to focus on the actual business processes that feed into these short-term performance indicators and look at what various things we might have to do strategically to change the way that we are just doing business. An example of changing an operating process could be if we evaluate moving from our current production to just-in-time production. So what are the costs and benefits of implementing a just-in-time system? Well, we know that the benefits are that we have less inventory carrying costs, less inventory holding costs. We could potentially have increases in sales, and we have decreased product costs. We could increase our customer response time, and we would reduce our manufacturing cycle efficiency time. We have an example here of customer response time and how we would measure customer response time. So the time between when the customer places the order for the product and when the order is delivered to the product. So we see the manufacturing cycle time is within the customer response time. So what time it takes for us to manufacture the product before we can even deliver it to the customer. And we've looked at the manufacturing cycle time in previous chapters. The manufacturing cycle time is the value rated processing time divided by the total manufacturing time. So it's the ratio of value added time to the sum of the total value added and non-value added time added together. That is the end of chapter 14. As I said, chapter 14 starts a 4-chapter analysis of operations and control. So we're going to be talking about variance analysis in the next couple of chapters and monitoring performance.